Well, we've now seen how the 1 percentage point interest rate cut has impacted on the Australian stock market today, a 5% drop in the value of Australian shares. Another big question now is, how is the cut going to impact on the housing market, which has long been at the heart of Australia's social and economic culture? For decades, Australia had been, or had one of the highest home ownership rates in the world. In fact, for many, until the recent explosion in superannuation funds, it's been the only way they've been able to accumulate any personal wealth at all. Associate Professor Stephen Keane has come increasingly to prominence over the past couple of years, specialising in the economics of Australia's spiralling household debt burden. Initially, he was almost a lone voice with his pessimistic view of how dramatically that burden could impact on us all. He's not alone now, and he believes Australia faces its own savage correction, including an inevitable housing slump. I spoke with Professor Keane earlier tonight. Steve Keane, I would think that when the Reserve announced its interest rate cut yesterday, that the reaction from most Australians, the first reaction, would have been to work out what the saving was on their mortgage repayments. The next question for many homeowners would be, will the value of my home start going up again? What is going to happen to the housing market now, particularly with the assumption that we're going to see more interest rate cuts?
Well, I think for a while there will be people who do the calculations and think, oh boy, happy days are here again, on to the next housing bubble. But the reality is housing prices in Australia now are running at about 7 times median incomes, when the affordable level, which the demographic survey works out rather well, is about 3 times. And to put that in context, the American market, after all the crashing it's been through, is down to 3.5 times median income level. So we're talking about a house price level in Australia which is twice the level that America got to. And that means, I think, unfortunately, the only direction in the long term for house prices is down.
And yet the local wisdom that has emerged from America's credit crunch, its subprime crisis, is that our problems, whatever they are nothing like theirs, that the subprime crisis has been a very dramatic collapse in the housing market.
Incredibly dramatic, and the reason was the subprime was really about lending money to people who had a record of not repaying it and claiming you could make money out of doing it, which was a classic American scam, and it's now falling apart, of course, not just in the hands of the poor Americans, but in the hands of some of the scam merchants as well. So that's something which is peculiarly American, but at the same time, our debt levels here are in fact slightly higher than those in America.
So, in other words, you're saying that there is a significant way for Australia's housing market to drop?
It has to be. It's simply unaffordable at the level it is now. The only way you can get your house to be sold for a higher price than you bought it for is if somebody takes out even more debt than you did relative to their incomes. And that's got to the point where it's simply unsustainable. The proportion of Australians who can afford to pay for the median home has dropped well below the actual median of the population.
Are we going to see home building start up again, or is that going to continue to slump? Are we likely to see those spiralling rents stabilise, or is that going to keep going up?
Well, I think, Kerry, I can actually make a reference to what's happened to the Australian dollar today and say every price you see is crazy. There is no way that the prices of anything make any sense at the moment. However, I think ultimately the most senseless prices are our house prices. They have to fall. In that environment, nobody is going to go into trying to build properties when there's an expectation of losing rather than capital gain. This has happened in New Zealand, it's happened in England, happening in America. The ratio of house builds to population has dropped dramatically once this crisis has hit, even when there have been housing shortages.
In your latest Debt Watch blog, you've compared private debt ratios for the US and Australia with those same debt ratios at the time of the Great Depression. How valid is that comparison? How do they compare? And what do you draw from it?
Well, if you look back to 1929, when the stock market bubble burst in America, the ratio of debt to GDP then was 150%. It rose to 215% as the economy collapsed, not because debt was rising anymore, but because prices were falling and output was also falling. It is now 290%. That is gigantic, virtually twice the level. Australia had a lower level of debt back at the start of the Great Depression. Our debt ratio is 64%. It is now 165%. So we have that much more debt than we had, and really the only sensible explanation of what caused the Great Depression is a combination of excessive debt and falling prices. Now we have one of those two in spades now, twice as bad as during the Great Depression on the OECD scale. So for that reason, I think the comparison is extremely valid and the prognosis is extremely bleak.
So within the landscape of the global economy, which again we're not sure, nobody really seems to be able to say with any confidence where it's going. What do you think is most likely to happen to the Australian economy now over the short to medium term?
I can see us going into a serious increase in unemployment, a serious economic slowdown, credit levels collapsing. We've already seen that starting to happen in the most recent figures, and a credit-driven downturn in the economy, driven largely through a collapse in retail sales, because this time round the part of society that's carrying the debt is the household sector. It was the business sector back in the 1920s and also, of course, in the 1990s. Households can't sack the kids. They can't declare themselves bankrupt anywhere near as easily as a corporation can do. So the only thing they can do to control the situation is to cut back drastically on their retail spending, and that will of course mean the retail sector is the first one to collapse. Well,
the household squeeze in the past year has been driven substantially by rising interest rates and rising petrol prices. Both those are now coming down quite dramatically. Won't that combine with the big tax cut now flowing through into household pockets to free up consumer spending again against what you're suggesting?
It certainly will help, and we're lucky in one sense that we have, first of all, a higher reserve rate than America, so we've got further to drop that reserve rate, and our mortgage rates are closer to the reserve rate. In America, there's absolutely no relationship between the reserve rate and mortgage rates. Reserve rates there have fallen from over 6% down to 2%, and mortgage rates have actually gone up across that period. So Americans got a much worse situation than we have. But even if you do have a dramatic drop in interest rates, that's nothing in terms of its impact on spending compared to what's happening to people deciding no longer to borrow. And this is where you need a monetary perspective on the economy. Our total spending is the sum of our GDP plus the change in debt. Last year, our GDP was roughly $1 trillion, and the increase in debt was roughly $250 billion. Now, if we suddenly have people deciding not to borrow anymore, that means $250 billion of spending power, even though it's borrowed money, disappears from the economy. If you're trying to top them up on the other side by reducing the interest payment burden, even knocking off 1% off the rates reduces the debt repayment burden by $18 billion, because debt now is roughly $1.8 trillion in this economy. $18 billion of an increase in spending power versus $250 billion of a fall in spending power. I'm sorry, the nays have it.
In your scenario, it would seem likely that interest rates are going to fall very significantly beyond what they've already done.
I was saying, even when the first rates cuts were being talked about before the last 0.25% cut, that I expected the reserve to be down to about 2% by the end of 2009 and probably 0 by 2010.
The share market, we saw Australia's share market tumble 5% again today. Over the course of this calendar year, Australia's down 31% in its share market value, Europe down 33%, America down 32%. Has that got a long way to run?
Unfortunately, yes. The American market is more overvalued than we are. Australian stock market isn't as big as the bubble there, isn't as big as the American stock market bubble got to be. But in the case of Japan, again, the Nikkei was 38,500 points right at the very end of 1989. It fell down to 7,000. It's now bouncing around 10, having reached 15. That's the scale of drop we can expect to see in America, and it's the same scale of drop they got back in 1929 when it fell from 380 to 44.
Very briefly, your best case scenario for Australia out of all of this, your worst case scenario?
Best case scenario is a recession more severe than 1990 and lasting about 1.5 times as long. Worst case scenario is something up to the level of the Great Depression, which was 20% unemployment and lasting up to a decade.
What's your advice to individual Australians right now?
Get out of debt. Simple as that.
It's not that simple, though, is it?
It isn't that simple.
It's not simple at all.
It takes difficult decisions to get out of debt, but that's the only thing to do. If you're liquid and if you have a secure job, you will do very well out of the coming environment. But if you're not liquid, if your assets are tied up, and if your job is at all vulnerable, then it can be very dark times ahead. But it also involves a political shift. We have to get away from the acquisitive society we've been part of, which really is driven by speculation rather than genuine production.
Stephen Keane, thanks for talking with us.
Welcome, Kerry.